All right, so this week we have the pleasure of hearing from one of our newest members, Jessica Oates. Jessica holds the residential mortgages seat in the BNI Thrive chapter, and she's a mortgage broker with DLC Harmony Mortgage Group for the last 2 years, which is based out of Chilliwack. Jessica assists individuals and couples with getting their financing approved for their next real estate purchase. She also specializes in working with first-time home buyers and existing home buyers in home equity loans. Jessica takes pride in being able to take all of the stress off her clients' shoulders by navigating them through the mortgage process in a way where the clients feel confident and in charge during one of the most stressful but exciting times in their lives. In addition to being a full-time mortgage broker, Jessica is also a full-time mom of 4-year-old twins, and she's a wife. These things take up the majority of her time, and in the little downtime she does get, she enjoys reading and listening to the latest crime genre podcasts, visiting new restaurants, and traveling. So something you may not know about Jessica is she holds a bachelor's degree in criminal justice and a certificate from the Justice Institute of BC for adult and youth probation officer. Jessica's ideal referral partners include realtors and really anyone who may benefit from getting mortgage advice. Because she's not tied to the typical 9-to-5 banker hours, she's able to be available outside of these times and provide timely advice. But that's enough from me. Let's hear from Jessica about her business so that we can send referrals her way.
That was quite the introduction. I appreciate it, Craig. Thank you. I'm just going to share my screen, so just give me 1 second to get this up and running. One second. Sorry. Can everybody see that? Yes.
That's good.
Awesome. All right. So hi, everyone. Thank you so much for the opportunity to present today. My name is Jessica, and I hold the mortgage broker seat at BNI Thrive. I currently work at DLC Harmony Mortgage Group in Chilliwack, but as a mostly virtual brokerage, we have the option to work with clients all over Canada. Today, I'm going to be speaking with you about everything qualifying, what you didn't know you needed to know. So let's get started. So what do I mean by qualifying? Qualifying is when the borrower goes through the application process, provides their documents, and then a rate hold is requested and a pre-approval letter is provided to the client. Once the initial application is received, I then confirm your employment type, which means looking at whether you are an employee or self-employed. And then I would request certain documents to verify your income. Only once I review the documents and supply you a pre-approval are you then qualified. Of course, there are many things that can completely derail a pre-approval once completed, and we will be covering these a little bit later. So what documents do I need to supply when completing a new application? The documents I would ask for are based off your employment type. The 2 most common types of employment are either employee or self-employed. If you are an employee, then you will need to supply a letter of employment, which does include start date, current salary or hourly wage, and guaranteed hours, your most recent pay stub, and your last 2 years of T4 documents and notice of assessment documents. If you are self-employed, then you do require additional documentation, including your last 2 years of T1 generals in full, which must be accountant completed, articles of incorporation, a copy of your business license for current and previous year, and your 2 most recent fiscal year's business financial statements. No matter your employment type, I would also ask you for a photo of your driver's license, a void check, and then a 90-day history for whatever account your down payment is sitting in. If you are divorced, you would also need to supply a copy of your separation agreement to show any alimony or child support payments. This is when we always get a little bit sticky on, because sometimes people don't, when they're common law and they separate and they didn't have any assets, they feel like they don't need to supply a separation agreement. So normally we can get away with it on that side of things, but if they did own any assets and they were breaking up and selling them like a house, even if they both took the exact same amount of money and walked away, they would still need a separation agreement to show where the money from the sale came from, which would be the division of assets. So the next step of qualifying, after you review your income documents and retrieve the rest of the needed documents to support your application, the client and I have a chat about potential lenders and rates, and I submit the file for 120-day rate hold to whichever lender is agreed upon. Once this is received back from the lender, I am then able to supply the client a letter of pre-approval, which states that I have reviewed their employment documents, credit bureau and down payment documents, and that I hold a pre-approval for the client in the amount of the offer. This letter does not include any numbers or figures on it, since we never want to show the client's hand when they are negotiating or bidding on a home. So can anything affect my qualification? Yes. When we provide a pre-approval letter, the broker will have a conversation with the client and let them know that the qualification is not set in stone and that there are certain items that can completely derail the entire application. So let's just break down a couple. The big one is purchasing a new vehicle. With every $400 monthly car payment, you reduce the mortgage amount you qualify for by approximately $100,000. This is huge, especially in the current market. $100,000 could be the make it or break it for the home of your dreams. And if you do go out and buy or lease a new vehicle, make sure you call your mortgage broker and let them know as soon as possible. They can then rerun the numbers and let you know if the previous amount that they had pre-approved you for is still valid or not. There's a big chance that the figure has been dramatically reduced though, and this can end up in a little bit of a broken heart on the borrower side of things. The next one is taking on any additional debts. This can also reduce the mortgage amount you qualify for. When you add additional debt, you again lower the amount you qualify for with a mortgage, since you will use two equations to qualify you. The first is the GDS, which stands for gross debt service ratios. And this is the percentage of your monthly household income that covers your housing costs. This must not exceed 39% of the application. And the second is the TDS, which stands for total debt service ratio. And this is the percentage of your monthly household income that covers your housing costs and any additional debts that show in your credit bureau. This includes lines of credit, credit cards, vehicle loans, and student loans, to name a few. The third thing that can unqualify you is if you spend your down payment funds. This would seem like common sense not to do, but we have seen it, so it's something that we feel we should mention. The lender is expecting to see down payment funds available for the last 90 days, plus any applicable closing costs. Closing costs are normally 1.5% of the home purchase price. And these can include legal fees, inspection costs, appraisal costs, and property transfer taxes, if applicable. If you spend these funds, then technically you no longer have a down payment available and no longer qualify. The last thing that can unqualify you is not paying your bills on time. This also seems like common sense, but we do have to mention it because people, again, don't pay their bills and then credit scores and everything else gets affected. Of course, when you don't pay your bills, as stated, this drops your credit score, which makes you no longer qualify for the loan potentially. Since the lender can pull your credit right up to the day of closing, it is so important not to do anything to jeopardize your credit, since they can pull the plug last minute if they feel you no longer meet their criteria. There are a few other items that can unqualify you, but these are the big ones that we cover with the client specifically, so they understand that the ball is in their court until closing day. If you were to do something to affect your qualification and pre-approval, the best thing to do is contact your mortgage broker as soon as possible so they can start looking at available options. The two main options that we normally will look at are either adding additional down payment to the application, either from your personal savings or a gift from a parent, or adding a cosigner to the application, which brings up the income and then hence helps you requalify. Do we recommend getting pre-approved? Oh yes. The best thing to do is get pre-approved and qualified before shopping. You would never shop for a car or even for groceries if you did not know your budget or how much you could spend. So why would you go shopping for the largest purchase of your life without knowing your budget first? Normally, a pre-approval qualification can be done in less than 24 hours once the client supplies their income documents. So it is in their best interest to take the time before home shopping to complete the pre-approval process. As well, this also speeds up the process once there's a live deal in play, since we do not have to go through the income documentation if everything is still valid for the application. So now that I've spoken about qualification, a few things that can affect your qualification and the steps. Does anybody have any questions?
Hi, Jessica. I do. Great presentation and such good information. Thank you. Can you just run through what the GDS and the TDS numbers are again?
Yes, of course. So your GDS, let me just go back to where I was talking about it. Of course, I can't find my notes. So your GDS is when you total gross debt. So that is the debt inside your home that you're paying for out of pocket. So those are bills and everything like that. And that can be up to 39% of your income. And then the next one would be your total debt service ratio, which is the percentage of your monthly household income that covers your housing costs. and that can be up to 44%.
Wow, those are quite good numbers. And yeah, again, just great information. Just a comment to say, and really important to understand that the lender can hold the credit bureau up until the very last day. So that's very, very valid and great information. Thank you.
Yes, thank you.
Question in regards to rate holds. So when you say 120-day rate hold, how does that affect you if the rate changes just like it did in the past 2 weeks here?
So with fixed rates, whatever the rate is that we hold for you, that will be the rate you'll get to access for your application for your home purchase. So that's helpful if you see the rates going up like we do every single day right now. I've got rate holds that are in at like 3.14, 3.04, and current rates are 3.89 and higher. So I have a client that purchased yesterday, they get to access their rate hold at 3.14 instead of the current 3.89 rates. With the variable rates, it is prime minus. So whatever prime is that day, you get minus whatever your pre-approval was. So that can be anywhere from 0.65 up to minus 1.1. So on current prime, that's 2.7 minus whatever your rate hold was. So if that fluctuates, you still get to access.
So even on a variable rate, it still allows you to have that buying power of the rate going into it, so you don't need to worry about the increase to your monthly mortgage payment when you go buy. That's amazing.
Yes, it is amazing.
Just on an example for say a $500,000 place, what would be the change of a mortgage payment going from say a 1.6 to a 3.2%? The difference there. I know.
Are you really going to make me do this right now? That is really inappropriate of you. So with fixed rate to variable right now, we're seeing anywhere from $400 to $600 when you go from variable to fixed. With variable, when it's fluctuating right now, every time it fluctuates by 0.25, you are seeing an increase of approximately $12 in payment on every $100,000 of mortgage you have.
Okay.
So, but for just variable versus fixed, we are seeing a range of about, $400 to $600, depending on if you want that fixed rate locked in or if you have that flexibility with a variable rate. Any other questions? No. Okay, I'm going to just stop my screen share here. 1 second. Craig, you can have it back.